And we're just going to kick you to the final bell, the first opening final bell of the week here, Monday through Friday. We got them all lined up.
That closes out today's trading day. All three of the major averages in the red, although well off their lows of the day. Dow closing off 163 points. We were off well over 300 points when we started the hour. S&P off just under 1%. The NASDAQ off about 1.5%. Here for a closer look at the broader markets, what we could expect heading into the new year. We want to bring in Liz Young, SoFi's head of investment strategy. Liz, it's great to see you. So before we dive into your 2023 look ahead, let's talk about what's been going on in the markets of late, because we have the S&P lower for the fourth trading day in a row. Certainly has seemed to turn a little bit when it comes to momentum. How does this set us up for the final 2 weeks of the year?
Well, Seana, there had been a lot of optimism for a year-end rally, or what everybody calls a Santa Claus rally. And I think that optimism faded when we heard from the Fed last week, where they just reiterated their hawkish stance and actually led everybody to believe that they would actually hold rates much higher for even longer than maybe we originally expected. Now, the difference is that when you look at what the bond market has been telling us, we've got curve inversions at the 2s, 10s, at the 3-month 10-year, and then at what's called the near-term forward spread. The bond market is screaming that things are not getting better, they're getting worse. And then you've got the macro environment. We have data rolling in that continues to look weaker and weaker, things that we're waiting to see, maybe some weakness in the labor market to come in December, January, but earnings also being revised down. So it seemed as if the stock market was the only thing that hadn't gotten the memo. And I think what we're seeing right now is more of a right sizing of those valuations.
You mentioned earnings, it revised down. You expect further downward revision?
I do, because right now the expectations are for basically flat growth year over year, 2023 versus 2022. And that seems a little bit optimistic given the environment and given the idea that wage pressures continue to be high. Companies are going to be having to pay those higher costs. And here's the thing that I think people are sort of thinking about, but maybe not realizing the big impact of is, if inflation falls, that means revenue falls too. A lot of companies have benefited from inflation and getting more revenue because you can sell things for a higher price. That pricing power had been really, really strong through 2022. It may not be as strong in 2023. So if revenue falls and costs don't fall at the same speed, that's obviously going to pressure margins. So I do expect more downward revisions early in 2023 when companies have to come out and start talking about what their plans are for the rest of the year.
Hey, Liz, Pras here. So does that mean that stocks are just still overpriced, relatively speaking, to where they maybe should be? You know, we've seen tech kind of come down really far, pretty fast. And, you know, is that a value now?
So there are some tech stocks that people are calling value now because of where they're trading. Here's what I would say about valuations. They're always a relative game. So there's not some magic number that I would say, okay, that's when it gets to that level, that's a buy. But we got up to 17.8 times forward earnings in this last rally. So the rally that started on that October low and took us through the last 2 weeks ago or so. 17.8 times forward earnings was above the 5 and 10-year average. So looking at that, you can't really assume in an environment where you've got the 10-year treasury at 3.5%, and over that 10-year period, it was at 2.1%. Or when you've got obviously higher rates continuing to rise more, it just doesn't make sense for stocks to be that highly valued. You have to believe in multiple expansion if you believe that we were going to continue in that bull market. So I do think that valuations need to come back down to earth a bit, especially given this environment.
Liz, how does this set us up just in terms of the debate about a recession, whether or not we're in one? And then you asked the question in your look ahead, how we're going to know when a real recession is here. Help explain that to us, because I think that's what so many investors have been asking themselves for so long now.
Yeah, I mean, look, the debate earlier this year was that technically we had one. We had 2 consecutive quarters of negative GDP. So everybody said, okay, that's it, it's over. But it wasn't over because it didn't reset the business cycle. And that's something else that I talk about in my outlook, is that you have to respect the business cycle. if we are decidedly late cycle, which I believe we are right now, in order to transition back into early cycle, you usually need a recession in between late and early. The good thing about having a recession, if there is one, is that it should cure the inflation problem. We cannot subsist with inflation at these levels. So if we left inflation alone and didn't do anything about it, it would put us in a recession anyway. So the question of how do we know it's the one? First of all, I think there would be a lot more macroeconomic data that's telling us things have weakened. We didn't really have that kind of data in the first half of this year. The big thing that you want to watch is the labor market. So the labor market has been, as we know, historically tight all year. We haven't lost a lot of jobs. We've heard headlines about layoffs, but it's been mostly contained to the tech sector, which makes up a very small percentage of the overall workforce in the United States. If that starts to spread into other sectors, which I expect that it will, we will start seeing it in the data that the labor market is weakening. Now, it doesn't necessarily need to get catastrophically bad. So that's why you're starting to hear people talk about maybe it's a mild recession, maybe it's an average recession, maybe it's a deep recession. The other thing about this is that what's different this time is if we go into a recession, we're going into it from a very strong labor market place. So it may not need to get as deep and as painful as far as labor goes as previous recessions.
And Liz, because of that setup, what's the strategy you recommend going forward into 23?
So for now, I'd still be waiting this out. And here's what I would say to all investors. You don't always have to be doing something. Sometimes it is better to just sit on the sidelines and wait for some of the uncertainties to subside. I would expect stocks to move lower into the end of the year. I don't think we're going to have a big year-end rally. There's not a lot of news that's going to happen between now and December 31st, so there's not a whole lot to be trading around, and volume is just lighter. I think we can look into January, start hearing from companies, let earnings season begin, and then see where things go. But again, watch those valuations. I think that we're going to get back down under 16 times on the S&P. And then when I come back on the show, maybe I'll be telling you that I've turned a little bit more bullish.
Liz Young, I hope we are. I hope you do turn more bullish. Thank you so much. Appreciate it.
Thank you.